Hey guys, what is going on? Welcome back to my Robinhood portfolio. This video, I thought I would take a look at what makes a good dividend stock. A lot of you guys have been asking how I pick stocks for not only my new investor videos, but for my portfolio overall. So I thought I'd take a look at two different stocks here, Avi Incorporated as well as Prospect Capital Corporation, or PSEC, with regards to payout ratio. And payout ratio is a metric that a lot of dividend investors take a look at initially to see how likely a company is to continue a dividend moving forward, which, as you can imagine, is very important for buy and hold strategies with dividend stocks. The payout ratio is pretty easy to understand. It's simply a ratio between the dividend per share given per year over the earnings per share given per year. So really the dividend per share divided by the earnings per share. So for example, if a company made $2 per share in earnings and gave out $1 per share in dividends, that would be 1 divided by 2, or a 50% payout ratio. If, for example, that same company made $2 earnings per share and gave out $2 in dividends per share, that would be 2 divided by 2, or a 100% payout ratio. And the payout ratio is very important because, again, it gives some prognostic or prediction power as to whether a company is likely to continue paying out a dividend. So, for example, a good dividend payout ratio would be between 35 and 55%. That would be a very healthy dividend payout. So the company would be essentially paying out 35 to 55% of all earnings to the investor in the form of a dividend. And this is important because that particular ratio is very sustainable over the long term. It means the company is healthy, being able to offer that kind of dividend, but it also is not too large as to become a burden on the company. High dividend payout ratios, 55% or greater, and even over 100%. Some companies like PSEC here on the right here, as we'll talk about, are giving out more in dividend payments than they earn per year. And as you can imagine, that is not sustainable over the long term. So having said all that, let's kind of take a look at two different stocks here. Avi, which has a great dividend payout ratio, and Prospect Capital, which has a very poor dividend payout ratio, or a very unsustainable payout ratio. So Avi Incorporated here, as you can see, is a pharmaceutical stock. Great dividend yield there, 3.91%. And if we go down on the bottom there, you can see there's a payout ratio of 46.6%. So that falls within the 35 to 55% payout ratio, which is considered a healthy payout ratio. And you can see there dividend growth over 44 years. So this is a dividend aristocrat. This stock has given out payment over at least 44 years, and it's increased that payment over 44 years. So this is a very good dividend stock. It's got a great dividend payout ratio. It's very sustainable, healthy payout ratio, and it has great dividend growth. 44 years, that is tremendous. If we take a look at Prospect Capital here, another dividend stock, you can see here the payout ratio is 106.4%. So you can see that this stock is giving out more to investors than it makes per year, and over the long term that is simply not sustainable. And you can see there the dividend growth is only it's only been in effect for 6 years. So this is not a very good dividend stock. Over the short term, it may give good returns, but over the long term, this is a stock that simply will not sustain its dividend. So again, a great dividend stock here, Avi Incorporated, payout ratio 46.6%, following that 35 to 55% ratio, which is considered healthy, with a great dividend growth and great sustained dividend over 44 years, versus Prospect Capital here, a payout ratio of 106.4%, which simply is unsustainable, with dividend growth only over 6 years. So yeah, that's how a lot of investors gauge whether a dividend stock is a good stock or a bad stock, whether the dividend is sustainable or not, looking at the payout ratio. So again, simple ratio of dividends per share given out over the earnings per share the company makes. So again, dividend payout ratios that fall between 35 and 55% are considered very healthy. Any payout ratio over that is considered a little bit unhealthy. Under that is unhealthy as well, because the company simply isn't able to give a dividend, which would suggest the company is not on great financial footing. And like I said, very high dividend payout ratios, dividend ratios are greater than 100%, are simply not sustainable. They're simply giving back to the investor a return of capital. I mean, they would have to take out money from the company to give back to the investor, because they're not making that much money. 100% would be giving the investor every dime the company made. Greater than that would be giving the investor their capital back from the company, return of capital, which I've put a couple videos out about prior. So again, take a look at the dividend payout ratio. Two examples here: a great dividend stock, AbbVie Incorporated, 46.6% payout ratio, dividend growth over 44 years, versus Prospect Capital Corporation, an unsustainable 106.4% payout ratio, and dividend growth only over 6 years. So yeah, so I'll kind of end the video here. I hope you guys enjoyed the video. I hope you guys learned a little bit about payout ratio. A little bit difficult to understand at first, but once you get a hang of it, it's very easy to understand. A dividend per share divided by the earnings per share really is an important metric to take a look at for all dividend stocks. So not to make the video too long here, I'll end the video here. As always, if you enjoy my videos, feel free to like, share, and subscribe. And until next video, we'll see you then.